Hey everyone, and welcome to Mind Over Markets, the show where we explore how psychology and finance collide and how our emotions can shape global trends. I'm your host, Alex Rivera. Today, we're diving into something that feels almost mythical, the unstoppable rise and dramatic crash of cryptocurrencies. Why do so many of us get swept up in crypto hype? And why does euphoria, that electric optimism, almost always lead to collapse? Joining me is Dr. Laura Chen, a behavioral finance researcher and crypto analyst who's been studying investor behavior for over a decade. Laura, welcome to the show.
Thanks, Alex. It's great to be here. And yes, I think this topic, crypto euphoria, really captures the essence of how human psychology drives the markets. We often talk about charts, volatility, and technology. But at the heart of every boom and bust, you'll always find people with hopes, fears, and dreams.
Exactly. And it feels timely. Every few years, we see another crypto surge. In 2017, it was Bitcoin's first big run. Then in 2021, NFTs and institutional investors flooded in. And this year, in 2025, we saw yet another cycle, another dizzying rise followed by a sharp fall.
Right, it's almost rhythmic, like the market breathes in optimism and exhales panic. What's fascinating is that even though the players and technologies evolve, the psychological patterns don't. We still see the same emotional curve: curiosity, excitement, overconfidence, denial, and then fear.
So it's not just a financial story, it's a human story. The way we react to money, risk, and opportunity hasn't really changed since the Dutch tulip mania or the dot-com bubble.
Exactly. Crypto just happens to be our latest mirror, reflecting our deepest emotional biases on a digital screen.
Let's start by breaking down how these cycles actually unfold. The report you helped write describes 4 phases: accumulation, euphoria, distribution, and despair. Can you walk us through those?
Sure. Think of it like the emotional life cycle of an asset. During the accumulation phase, experienced investors, often called whales, buy quietly when prices are low and public interest is minimal. It's calm. Nobody's tweeting about it. Then comes euphoria. Prices climb, social media buzzes, and suddenly everyone wants in. That's when the average person, your friend, your coworker, your aunt, decides to invest. Rational analysis fades. The narrative becomes, it can only go up.
That's the dangerous part when optimism turns into a collective delusion.
Exactly. Then we reach distribution, where those early investors, the whales, start selling their holdings to latecomers who believe they're still early. Finally comes despair. Prices crash, panic takes over, and investors sell at a loss.
It's brutal, but it's predictable. And we've seen this play out time and again in 2017 with ICOs, in 2021 with NFTs, and even this year when Bitcoin dropped from 126,000 to 105,000 in just hours.
That's right. Each crash looks different on the surface, but the psychology behind it, the herd mentality, stays the same.
Let's talk about that euphoria. What's actually happening in our brains when we feel like the market can't lose?
It's pure neurochemistry. When prices go up and we see others getting rich, our brains release dopamine, the same neurotransmitter linked to pleasure and reward. It's addictive. You start to associate crypto gains with personal success or intelligence, even if luck played a huge role.
Right. It's like the market becomes a casino, but dressed in the language of innovation.
Exactly. And social media amplifies it. Influencers post screenshots of profits, online communities reinforce the belief that this time is different, and soon you get a feedback loop of optimism. That's where FOMO kicks in. People buy not because they've analyzed the fundamentals, but because everyone else seems to be winning.
That's powerful. And when the market turns, those same emotions flip. Dopamine turns to cortisol, excitement turns to anxiety, and suddenly everyone's scrambling to get out.
Yes, fear spreads faster than enthusiasm. That's why crashes often happen faster than climbs. It's not algorithms, it's adrenaline and panic.
I think one of the most painful parts of these cycles is the human toll. The headlines usually focus on billionaires losing billions, but the real impact hits small investors.
Absolutely. After the FTX collapse in 2022, we saw average retail investors losing almost half their savings. The data shows the average person lost about $431 from a $900 investment. For some families, that was grocery money or tuition savings. And in regions with limited financial education, the damage was even worse.
That's heartbreaking, especially when people got in because of hope, not greed.
Exactly. Hope is what drives participation, but unchecked hope turns into euphoria, and euphoria is expensive.
So let's shift gears. What can we learn from all this? You've said before that every crypto crash leaves behind valuable lessons. What are some of the most important ones?
First, avoid excessive leverage. Borrowing money to invest multiplies both gains and losses. In 2025, mass liquidations of leveraged accounts caused record-breaking losses. Second, avoid overexposure to speculative altcoins. These tend to drop 60 to 80% during a crash, while Bitcoin and Ethereum usually recover faster. Third, beware of crowd psychology. When everyone believes something, it's often too late to profit from it.
Right. The illusion of consensus.
Exactly. Finally, diversification still matters. Even in the digital age, traditional assets like stocks and bonds provide balance. But the most powerful tool is emotional discipline. The ability to stay calm, to not buy during euphoria or sell during panic. That's what separates long-term investors from emotional traders.
So, for people listening right now, maybe they've been burned by the last crash or they're still holding their coins. What can they do differently?
Start with rules. Write down your entry and exit points before investing. That prevents emotional decisions in the heat of the moment. Next, commit to continuous education. Read white papers, follow credible analysts, and avoid hype channels. Third, think long-term. If your time horizon is 3 years or more, short-term volatility becomes noise.
That's such a good point. Patience is underrated.
Exactly. And finally, recognize the warning signs of a bubble. Disproportionate media attention, prices detached from real-world utility, exaggerated promises of guaranteed returns. If you start hearing things like it's impossible to lose, that's usually the moment to step back.
I love that. It's the surest sign of danger when people say, this time it's different.
Yes, every bubble says that, and every bubble proves it wrong.
You mentioned emotional discipline earlier, and I'd love to dig deeper into that. Why is managing our emotions so hard when it comes to money?
Because money is never just about numbers. It's tied to identity, security, and status. When we make money, we feel smart, validated, even powerful. When we lose it, we feel shame and regret. That emotional roller coaster distorts decision-making.
So, in a way, investing isn't about beating the market, it's about beating your own impulses.
Exactly. Behavioral finance research shows that we experience financial losses about twice as intensely as gains. So after a loss, people often take irrational risks to recover, the classic revenge trade.
That sounds exhausting, like trying to win back your dignity through the market.
It is. That's why the most successful investors develop a mindset of detachment. They view investments as data, not emotions. They accept uncertainty as part of the process instead of reacting to it.
It reminds me of meditation, actually, watching thoughts, or in this case, market movements, without attaching to them.
Exactly. Emotional awareness is a financial skill. Learning to pause before acting is just as valuable as knowing how to read a chart.
Let's wrap up with something practical. If someone wants to invest more consciously, not just in crypto, but in any market, what would you recommend?
3 things. First, build a written strategy. Define your goals, risk tolerance, and exit plan. Second, automate your discipline. Set recurring investments or stop-loss orders so emotion doesn't hijack your judgment. Third, stay humble. The market owes no one profit. Treat every win as temporary and every loss as a lesson.
That's beautifully said. And maybe the ultimate takeaway is awareness that investing is as much an inner journey as it is a financial one.
Exactly. True financial freedom begins when you're no longer controlled by euphoria or fear, when you can observe the storm without getting swept away.
What a conversation. We've gone from Bitcoin's wild highs to the quiet discipline of long term thinking. If there's one thing I'm taking away, it's this. Markets may evolve, but human psychology doesn't. The same emotions that built the first bubbles still drive the digital ones today.
That's right. And the good news is, awareness changes everything. Once you understand your own biases, you can make better decisions, not just with crypto, but with any investment or even in everyday life.
Exactly.